Hello, Fools. I'm Robert Brokamp, the Senior Advisor for the Motley Fool's Rule Your Retirement Service. And as part of our Ask the Fool series, we have a question from Art. Art says, my 401k has an S&P 500 index fund with an expense ratio that is only 0.05% and has a return of 6.85% so far this year. My other fund has an expense ratio of 0.93% and has only returned 4.19%. I'm paying more to get less return. Any suggestions? Well, Art, you have discovered what experts have known for a long time, and that is most actively managed funds do not beat an index fund. Well, let's define those. An actively managed fund is a fund by which the fund company pays a bunch of managers and analysts to pick the best stocks, or it could be bonds if it's a bond fund, and try to outperform the market. An index fund just mimics the market, and because they don't have those analysts and managers, the money that they have to spend on managing it is actually quite low. So partially due to those higher expenses with actively managed funds, most actually don't outperform the market. So I would say to you, first of all, if that one fund is not beating a relevant index fund, then get rid of it. Check all your other actively managed funds. If they are not beating a relevant index fund over 3 to 5 years, you should also consider getting rid of those. I will say that a 0.05% expense ratio on your S&P 500 index fund is excellent. Kudos to your employer for getting such a good deal on a fund. And because that, to me, is evidence that your employer cares about the quality of your 401k, you can bring up this other fund to your employer and say, listen, this one's not very good. Can we replace it? And hopefully they'll listen to what you have to say. Hope that helps. If you have any other questions about retirement planning or investing in general, just visit us on Fool.com.
People on the show may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against.